Hey everyone, as always, this is Hunter Satterfield, the Chief Investment Officer and one of the partners here at Kane Waters. I am joined by my fellow partner and the head of our investment committee, Brian Bortz, as well as Brad Sanders, the Managing Director of Tectonic Advisors. This is your February market update. For the month of February, we saw the S&P 500 down 2.5% just for the month. Global stocks down 2.8%. Domestic bonds down 2.6%, and then wrapping things up, global bonds down 3.3%. So roughly everything down around the same amount. And this echoes a lot of what we talked about at our January market update, that we felt like despite the good returns in the month of January, that we still had some volatility ahead of us. Little did we know that would occur in February. That remains consistent with what we're seeing. But Brad, I'd love to come over to you to sort of just talk specifically about what happened in both the equity and fixed income markets in February to sort of cause this downturn in the market.
Sure. I mean, it really starts and stops with interest rates. We saw the short end of the curve really take off. The Fed raised a quarter basis point earlier in the month. And the market is starting to price in more rate hikes than they had previously. You know, we've mentioned before, we think it's kind of funny that everybody wants to fight the Fed now, but, you know, the last 10 years, the mantra was don't fight the Fed. And we choose to just not fight them all the time and not try to, you know, only do it when things are going our way. You know, when interest rates are higher, markets act differently. We've just gone through a decade where you had zero or near zero rates. And so, you know, everything kind of marches to the beat of a different drum. But, you know, what you're seeing really is everything being re-rated and markets starting to behave kind of like they're supposed to. And, you know, there's a lot of hand-wringing and all this about what the Fed's going to do and how much they're going to raise rates. And it does matter in terms of, you know, how you position your portfolio. We believe we're positioned correctly and all that. But really, in a lot of ways, it doesn't matter. If you're an investor that pays attention to fundamentals, you should welcome a little bit of a higher interest rate because it makes things make a lot more sense. It makes things easier to do. It makes decision making a lot easier when you actually have a risk-free rate that's non-zero. So it makes us a little bit excited that rates are getting up there. We don't want them to get so high that something breaks, but it does make investing, particularly in the equity market, a lot more. You just have more visibility when you have higher rates. And you know, everybody now is turning to, are we going to have a recession or not? And what's the definition of a recession? I mean, if you really think about it, we've kind of been in one. GDP has been growing below the rate of interest. GDP has been growing below the rate of inflation for like 6 quarters now. It's 7 quarters, I believe. So on a nominal basis, the economy is shrinking, right? So if we want to, you know, change definitions and all that, that's fine. But to us, markets are in a recession. And we think it'll show up in earnings, and we've kind of gone over what's going on with the consumer. But I just think February, to wrap it all up, it's just reality setting in. January was a little bit of probably an anomaly. We don't expect every month to be this bad this year, but we do think, you know, the markets have now drifted back to a level that's much more reasonable given the economic backdrop.
Yeah, it's helpful. And I think, you know, you referenced several things, which are great for our listeners. You know, I think first is just sort of that there are sectors, actually pockets in both markets, the fixed income and equity markets, that are performing well if you look at fundamental analysis. And so it's important, obviously, to just focus in on good fundamentals when we're thinking about that. The second thing you mentioned, which Brian, I want to come over to you on, is a little bit of a talk of, you know, what's the Fed going to do? And I know there is some hand wringing, like you said, Brad, but we are probably what we thought was going to happen may or may not happen. So, Brian, you want to talk a little bit about what we're seeing on potentially what the Fed may end up doing with some more rate increases?
Yeah, thanks, Hunter. I appreciate it. You know, originally our thought process was more hopeful that the Fed would only raise a couple of more times and maybe only a quarter point each time. It looks like now that most traders believe that the Fed funds rate is going to go up a full percent from where we are right now between now and September. So at least that's kind of what's being priced in right now. I think that only time will tell. I agree with what you said earlier and what Brad said earlier, that it's kind of folly to try to predict what the Fed's going to do, so we don't fight that. I love a couple of comments that Brad mentioned a second ago that I want to reiterate to all our listeners. One, the market's behaving as it's expected to do now, which it hasn't for quite a while. So we're really optimistic about that the market is starting to behave like it should. And the second thing, as Brad mentioned, we really kind of are in a recession. Nobody in Washington wants to call it that. But the fact of the matter is that if you look back over history, there are kind of three technical markers of what a recession is. Was the market ever down by more than 20%? And yes, last year it was numerous times. It ended down 19.4 or something like that, but it was down over 20% numerous times. Check that box. Did we have an inverted yield curve? Yes, check that box. Did we ever have 2 consecutive quarters of negative GDP? Yes, check that box. So really, the markets are in a recession, just nobody's admitting it. And if you really look at how we have done and how we're positioned, we protected incredibly well. And I feel really good about how we are positioned going forward. So the optimistic side of me says inflation used to be at 9%. Now it's at 6.4. Unemployment is still low. So that's good. People are working. I think we are in good shape going forward, but there's still going to be a heck of a lot of volatility this year, as we have mentioned for quite a while. So that's where I think we are.
Yeah, thanks.
If I could
Absolutely.
jump in real quick, Brian just said something. I have a chart. I do these Friday presentations. Brian's talking about what the market's pricing in, the Fed's going to do. The market historically is always wrong. They are always expecting the Fed to raise rates when the Fed is like not doing anything or cutting, and they're always expecting the Fed to cut rates when the Fed's raising them. So when we talk about the Fed, what the market's pricing it to do, that could be the opposite of what ends up happening. So, don't take that. And if it looks like the Fed's going to raise 1%, that does not necessarily mean, that's what they're going to do. And in fact, a lot of times that's completely wrong. And I just think it's interesting what the market does, and historically, they're almost always sideways. It's really kind of fascinating.
Yeah, thanks for that, Brad, because that was I was going to finish up is the reality is that uncertainty is what creates volatility. And so we are uncertain on what the Fed's going to do, and the market has no idea necessarily either. And so, that's sort of our job here is just stay the course and invest with good fundamentals and invest with a long-term approach. And so as we sit here 16% through 2023, we'll continue to go forward with that mantra for the remainder of the year. So we'll be back in front of you at the end of March. Have a wonderful March as we leap into spring. Thank you so much.